Hello everyone and welcome. Today Trafigura has published its annual results for the year ending September 2025. To take you through the results and the story behind them, we're joined by our Chief Executive Richard Holtum and our Chief Financial Officer Stephan Jansma. Richard, let's start with you. How would you describe this year's performance?
I think actually really pretty good. Really pretty good as an absolute level, but also as a relative level compared to our peers. I think trading conditions were not easy last year, and I think that our trading teams put on a really credible performance across all three divisions. The thing that I was most proud of was the diversity of the business. All three trading divisions put on really credible performances. Every book did a decent job, and when you're as diversified as us, if every book does a decent job, the overall performance is very good.
And Stephan, just to bring you in here, is there a sort of a key metric or key number that you would point to just to sort of reinforce what Richard's saying there about the strong results and the resilience?
Sure. I think all the numbers that we're showing have been really consistent. If I have to pick out one, it's really EBITDA. It's the fourth consecutive year that we have an EBITDA in excess of $8 billion. It was definitely not an easy year. Nevertheless, to generate 8 billion EBITDA is a very remarkable feature. And what it really does, it provides the comfort to have a long-term view by our banks, by our ECA providers, as well as by the capital markets. And hence, due to that strong performance, we've been able to raise 12-year money, for example, on the US private placement market. We went back to the Reg S bond market where we issued $500 million at a record tighter spread. As well as we've been very active on the ECA market, again, due to that strong underlying EBITDA generation profitability.
Okay, and then when you are just delving a bit deeper, you look at the balance sheet, the liquidity position, what would you point to there?
I think the balance sheet and liquidity is extremely robust and comforting. This year we show 15 billion of liquidity. The change there is that this year a lot of the liquidity is available, one phone call away, but it's not shown on our balance sheet. So cash and cash equivalent is lower than last year, but the liquidity is the same as we've always had.
And just moving away from the numbers quickly, Richard, just to come to you, when you came into the job in January, you talked about making the business simpler, smarter and sharper. How has that gone?
Yeah, so I think that's something very important for us, that the simplification of our business, we have to do what we are good at. And if we're doing things that aren't our core skill, we simply should not do them. And the biggest example there, I would say, is our Columbia multimodal barging system, which we have now shut down. It's also when we go into new businesses, let's make sure it's the next adjacent business with significant synergies to what we're doing today. So you look at, for example, our veg oil business that we started in the oil division, or our gold business that we started in the metals division. These are the next adjacent businesses where we already have significant relationships, significant synergies. We're only going to do things where we add value. Then if you look at smarter, that's involving AI in everything we do. So people need to use AI in everything they do, and that will make people so much more efficient. And then in terms of the sharper piece, that's driving accountability at all levels of the organization. We've run a very large governance and controls project, and the result of that is that what we're trying to get everyone to do is to constantly ask the question why. If everyone has that questioning mindset, we will become an organization that is constantly self-improving. And that to me is an extremely important cultural change that we have to bring into the organization.
And Stephan, just coming back to the numbers once more, I mean, a strong underlying performance, as you said, yet there are some impairment charges in the figures. Can you just run us through the drivers behind those?
Sure. If I look at those impairment charges, right, the significant largest one in there is in relation to the near-star assets that we have. There are definitely some headwinds on the macroeconomic environment in that, and we've had challenges there, so we've had to, in a way, right-size the balance sheet for those assets. On the positive side there, we've seen strong support from the Australian government for the assets, and hence we've received a 9-month kind of bridge facility to something hopefully more structurally to support the industry in Australia.
So tough conditions facing the smelting industry in Australia and indeed worldwide, but some recognition, at least from governments now, that these are important assets that need to be preserved.
Exactly. Smelting is absolutely critical to national security. As we've said before, if you dig stuff out of the ground, you have dirt. If you have a smelter, you have the refined metal and the critical mineral metals that you need. So the macroeconomic conditions are not profitable for smelters. We have to make sure smelters remain operating, because once they're gone, they're gone.
Now, Stephan, profits and dividends broadly aligned this year. How should we think about that?
Just like you said, our profits and dividends are roughly aligned this year. And what we're doing there is we're paying dividend just like any listed company would do. If I look at the ratios, we want to have an equity of around $15 billion given the current asset portfolio that we have.
Now, looking ahead to 2026, I'd like to ask you both what your priorities are. Stephan, if I could start with you first, what are your priorities and how do you see some of our key markets evolving?
So we've made a lot of improvements from an operational perspective, from an organizational perspective, but also from a cultural perspective. My focus is on 3 points. One is really to optimize the fundraising that we do, which at times can be that we look at more competitive fundraising, but sometimes also more strategically in terms of longer tenors. A second priority would be to look at the way we're being financed. We've become a corporate who is active in the commodity markets, and I think our financing model should evolve in that way as well. And the third point is really efficiency. We spoke about AI, which is something we really try to implement into our finance functions in terms, for example, of payment structures, reconciliations of FX, for example, etc., etc.
And Richard, markets and priorities. Let's start with markets first. How do you see those evolving in 26?
What we saw last year was significant headline-driven volatility. I don't think is going to change, so I expect 2026 to see that significant headline-driven volatility to continue. But the way I see it is, what is Trafigura's role in the world? Our role is to sit as a shock absorber between the customer and the macroeconomic environment. So when the road is flat, the shock absorber doesn't have to do a huge amount. But when the road is rocky or bumpy, that shock absorber has to do an awful lot of work, which means that people are working extremely hard. But as a result, we're also managing to deliver significant value to our customer. And I'm extremely convinced that all 3 trading divisions have definitely the right people in the right seats to make sure we can deliver significant value to the business. I'm extremely excited about both next year and the next few years for Trafigura.
Okay, well, thank you both for joining me today and talking me through the story of these results. Thank you.
Super. Cheers, Neil. Thank you.
Thank you.